The S&P 500 has been hitting resistance. Its recent highs fell short of its 200-day moving average, and more than 90% of stocks in the index have been trading above their 50-day moving average on the plus side. That fits the definition of what our next guest calls a breadth thrust. Let's find out what exactly that means and whether we can see this the rise that we have seen continue as we hear from the Fed on Friday. Charles Schwab's chief investment strategist, Ann Sonders, joins us now to weigh in. Love the jargon. I'm not actually being ironic. It's fun to learn these new terms, Ann. So talk to us about what a breadth thrust is and what this one tells us about where we're going next.
Hi, Julie. Well, it's actually, in my world, it's a very old term because I learned this concept from my first boss in this business 36 years ago when I first started in the business in 1986, the late, great Marty Zweig, and he actually invented some of not just the language, but the methodology for judging them. So it is just a huge surge in breadth to the point you made about 90. At the peak, we had 93% of stocks trading above 50-day moving average. There were several buts, though, this time. And number one, the bumping up against the 200-day moving average as resistance. In the case of the S&P, it couldn't breach that. The other rub is that it was a still downtrending 200-day moving average. So when you look at the past, although a breadth thrust shows strong participation, when you've got those other two conditions, it's actually more often followed by some of the volatility that we're seeing recently. So it was not that there's ever a perfect technical or breadth signal, but that one had some important caveats that I think we're seeing the manifestation of that recently.
Liz, should we expect the Fed to signal any type of pivot that the markets would rally on this Friday when we hear from them out of Jackson Hole?
I can't imagine. First of all, to the extent that by pivot one is talking about a move from aggressive rate hikes to cuts, I don't understand that narrative at all. I think simply because inflation may have peaked and has started to come down is not a green light for the Fed to move to rate cuts. That would just risk reigniting inflation all over again, not to mention the fact that their other mandate certainly doesn't justify rate cuts at this point, meaning the labor market. I think the only thing that would allow the Fed to truly pivot from hikes to cuts would be a combination of sustainable move down in inflation coupled with pretty significant weakness in the labor market, such that both of their dual mandate comes into focus. That is more of a poor economic backdrop, even from these levels. I think there's a possibility down the road, maybe not imminently, where the Fed could pause and reassess, but a true pivot to rate cuts, I think that's a ways off.
Ann, to that extent, what do you think perhaps a more hawkish or just a hawkish tone from Jerome Powell, what does that mean to this meme stock movement that has reignited over the past few weeks?
I don't understand the meme stock movement, quite frankly. I don't think it really had anything to do with the Fed or a pivot or what's going to be said at Jackson Hole. It was yet again, Wall Street Bets on Reddit. It sort of fuels this gambling mentality. You have different poster children. This time it was Bed Bath & Beyond. And unfortunately, probably a lot of smaller traders that got into that thing when it was up 400 or 500% from the lows have now suffered a 60, 70% decline in the stock. So I have no idea what drives those stocks on the upside or the downside. I think the Fed sounding more hawkish could be a volatility driver. That said, I think the expectation that they might do that, they might push back on the recent loosening in financial conditions, could be a fundamental reason behind this period of weakness in the market since the mid-August highs. But as it relates to the meme stocks, I have no idea.
Listen, that makes all of us, I think. And we try to piece through this stuff every day. But if we take a wider lens on the retail investor and just talk more broadly about retail sentiment, right, not just on those stocks, but more broadly, it definitely feels like, I was talking with a friend at lunch yesterday about the sort of vibe shift that we have seen in the past month, that things don't feel as gloomy in the markets when it comes to the perception of what's happening with a recession or not, what market action has looked like. Is that what you're also hearing from, in particular, retail investors or institutional investors for that matter?
Well, we do very, very broad retail investor surveys on sentiment, but done not on a day-to-day or week-to-week frequency. And what our latest data shows is still some skepticism, but improved from maybe the depths of where we were around the mid-June lows. Looking at more higher frequency sentiment data, and I look at every variety of it, you have to, first of all, look at behavioral sentiment and attitudinal sentiment. Sometimes those can be quite different. Attitudinal sentiment measures have remained fairly cautious. However, some positioning-based sentiment measures, like a low put-call ratio, some of the flow data, some of what we already talked about, the sort of gambling mentality kicking back in areas like the meme stocks, suggests that some of those shorter-term behavioral measures of sentiment did move back into the extreme optimism, frothy, high complacency, whatever terminology you want to use. But it has been an interesting rally because it hit with sentiment ultimately, even after 2 months, being a bit of a mixed bag. And it really depended on short-term, long-term behavioral, attitudinal, and what cohort of retail investors you're talking about.
And particularly here, I guess, when we think about the consumers in this economy right now that are feeling the impacts of inflation, most notably, whether that's the acknowledgement that they receive from the Bank of America CEO or San Francisco Fed President Mary Daly saying that I may not feel the impacts of inflation or a recession, most notably for me, but I know that there are others out there in the economy that are feeling that. How much longer can that persist without us running the risk of a much larger detriment being incurred within the economy?
Well, I think we're already suffering the consequences, especially down the income spectrum where inflation bites to a more significant degree, even though the lower income cohort has the highest wage increase relative to higher income cohort. That's good news. No matter what cohort you're looking at, real wages are still in negative territory, and the percent of disposable income that has to go toward the necessities, be it energy or food related products, is much higher, obviously, down the income spectrum. So you've seen a huge surge in revolving credit. You're seeing what the retailers have been talking about sort of downscaling to store brands and eliminating more discretionary type purchases. So I don't think that's something prospective. I think it's already happening. And to your point about some people feel inflation differently, everybody has their own personal inflation rate. Do you drive a car? Do you not drive a car? Do you have high healthcare costs, low healthcare costs? I mean, the list goes on and on. So admittedly, everybody's personal inflation rate, regardless of what income bracket is in, depends on your circumstances and is going to vary. Do you own a home? And if so, where? Do you rent a home? So it's a much wider spread around a metric like CPI, and it's very personal in nature.
Yeah, that's a really, really good point, depending on what you buy and what you own. The PIR, I think we'll coin that now based on the personal inflation rate. Thanks, Liz Ann. Always great to get time with you. Liz Ann Sonders, Charles Schwab, Chief Investment Strategist. Appreciate it.